In 2005, Boeing sold its biggest fuselage factory to a private equity firm for $900 million. 20 years later, in December 2025, Boeing bought it back. Same factory, same machines, many of the same workers. What about the price this time? Nearly 5 times what they sold it for, plus billions in assumed debt. Plus, and this is the part nobody's talking about, a confession from the CFO that they hadn't told shareholders the truth before closing. This is the story of how a company undid its smartest financial trick and then made it worse. I went through Boeing's Q1 2026 10Q for this one. There is a number in there that mainstream coverage missed entirely, and it changes how you read the whole deal. I'll get to it. If you want my full breakdown of every Boeing's earning release as it lands, link is in the description for my newsletter. To understand what just happened, you need to understand what Spirit AeroSystems even is. Spirit makes the fuselage, the actual tube of every Boeing 737, the cockpit and front section of every 777, every 787. They're not just small parts vendor, they build the airplane. In 2005, Boeing didn't want to own that anymore. The thinking went like this: factories are expensive, pensions are expensive, strikes are expensive. What if we sold the whole thing to a buyer who could run it leaner, and then we just buy the fuselages back from them? Same parts, less risk on our balance sheet. So Boeing did that exactly. Sold the operation to a Canadian private equity firm called Onex. Took $900 million in cash, got rid of $300 million in liabilities. Wall Street loved it. Now fast forward to 2024, a door plug, that's a panel in the side of a 737, blows off a brand new Alaska Airlines jet in 14,000 feet. The plane lands, nobody dies, but the NTSB investigation finds something terrifying. 4 bolts that should have held the door plug in place were never installed. 6 months later, Boeing announces it's buying Spirit back. The mainstream story you've heard in every news outlet. Boeing is fixing its supply chain, bringing fuselage production back in-house, rebuilding quality control. That story isn't wrong, it's just incomplete, because the contrarian read is this: Boeing isn't fixing its supply chain, it's being forced to undo a 20-year financial engineering experiment, and the people running the undoing, they're using the exact same playbook. Short-term spin over long-term truth. That broke the company in the first place. Watch what happens when you follow the numbers. Let's start with the 2005 sale. According to Boeing's 2005 8K filing with the SEC, $900 million in cash to Boeing, plus the buyer took $300 million of liability off Boeing's books, plus long-term supply agreements guaranteeing Boeing would buy fuselages at agreed prices. Wall Street analysts at the time called it elegant. Boeing got cash without losing access to its planes. Now look at who bought it. Onex Corporation put in roughly $108 million of its own equity. Their fund partners shipped in another $267 million. Total equity check, about $375 million. When Onex sold its last Spirit shares in August 2014, it had pulled in approximately $3.2 billion. That's an 8.5x return on equity in 9 years. In the same 9 years, the S&P 500 returned about 2.6x total, so Onex beat the S&P 500 3 times over on a deal that started with a Boeing factory. The private equity buyer made a fortune. Boeing got the original cash, plus 19 more years of fuselage problems, and that's not even the worst part. January 5th, 2024, a 737 MAX 9 takes off from Portland. 3 minutes in, at 14,830 feet, a door plug, a plug-shaped panel in the side of the plane, separates from the fuselage. The cabin depressurizes. Phones, headphones, a kid's shirt, all sucked out the hole. Nobody dies. The pilots land, but the NTSB starts pulling threads. What they find in September 2023, that fuselage came from Spirit's Wichita plant with damaged rivets near the door plug. Spirit sent a team to Boeing's Renton factory to fix them. To do the repair, the door plug had to be opened. The 4 bolts that hold it in place were removed. Then the door plug was closed by Boeing's personnel without the bolts, without documentation. The plane flew 154 flights like that. The door plug woken up its track a millimeter per flight before it finally let go. The NTSB's official probable cause, issued in June 2025, Boeing's failure to provide adequate training, guidance, and oversight. This is the supply chain Boeing built when it sold Spirit in 2005. 6 months after the dog plug incident, on June 30th, 2024, Boeing announces a deal to reacquire Spirit. The price was $37.25 per share, all stock. Total equity value of $4.7 billion. But Spirit also has debts. When Boeing assumes Spirit's existing borrowings, the total enterprise value of the deal climbs to roughly $8.3 billion. So let's pull up the receipt. In 2005, Boeing collected $900 million for this business. In 2025, Boeing wrote a check for $8.3 billion to get it back. Same machines, same factories, in Wichita, in Tulsa, in Prestwick, Scotland. That's a 9X wing, and that's before you count the door plug retrofits, the Alaska Airlines lawsuits, production caps, or the FAA fines. Now here's where the contrarian story actually begins. The deal closes on December 8th, 2025. Boeing tells shareholders the integration is on plan. They say full year 2026 will be the year Boeing's commercial airplane division returns to flat or positive operating margins. 3 months later, March of 2026, Bank of America Industrials Conference, Boeing CFO Jay Malave takes the stage and he says on the record that target, the flat or positive 2026 margin, it's now 2027. The integration is costing roughly $1 billion more in 2026 cash flow than what Boeing told shareholders before closing. Translate that out of finance speak. The people who sold this deal to investors knew the supply chain was broken. They saw it every day, in every fuselage that arrived at Renton with quality issues, but they couldn't say so loudly until the deal was closed, because if they had, the deal might not have closed at all. This is the same incentive structure that broke Boeing in 2025. Tell Wall Street the optimistic story. Worry about the operational truth later. Now, let me show you the bill. According to Boeing's own Q4 2025 8K filings, total debt at year-end was $54.1 billion. Cash on hand was $29.4 billion. Of that debt, roughly $8 billion comes due in 2026 alone. Boeing's own free cash flow guidance for full year 2026, $1 to $3 billion. That's not enough to cover the maturity wall, even at the high end. So Boeing has to refinance, and refinancing $8 billion at 2026 interest rates costs a lot more than what they were paying in 2019. This is a company that paid $8.3 billion to fix a problem it created 20 years ago, and then loaded another $1 billion of hidden integration costs on top of $54 billion of existing debt. If this kind of breakdown, pulling the actual goodwill number out of the 10K, comparing it to the 2005 deal terms in Boeing's old 8K, is the kind of thing you wish more financial coverage did. That's basically the whole point of my newsletter. Twice a week, one company breakdown like this one. Free, link is in the description, pinned in the comments. So what's the actual story? The mainstream narrative says Boeing is reabsorbing Spirit to fix safety, to rebuild quality, to bring the supply chain home. That story isn't wrong, but it stops at the surface. The deeper story is that Boeing is being forced to undo a financial engineering experiment that started in 2005, and the people running the undo are using the exact same playbook that caused the original problem. In 2005, Boeing's leadership had a choice: build long-term operational capacity in Wichita or sell it for cash and please Wall Street. They picked Wall Street. In 2024, Boeing's leadership had another choice: tell shareholders honestly that buying Spirit back would cost more than the public numbers suggested, or close the deal first and confess later. They picked confess later. Same incentive, same playbook, 20 years apart. And here's the punchline. When the FTC approved the deal in February 2026, they attached a consent order. Boeing must divest Spirit's Malaysian operations. Boeing must continue supplying aerostructures to Airbus on existing terms. Boeing must keep providing parts to its competitors in US defense aircraft. That means that Boeing is allowed to bring Spirit in-house, but not allowed to use the integrated supply chain to choke its competitors, which was supposed to be one of the long-term strategic benefits Boeing pitched internally. So the deal Boeing pitched to shareholders, buy Spirit, fix supply chain, gain market power, is being delivered as buy Spirit at a 9x markup, eat $1 billion in hidden integration costs, give up the strategic mode to satisfy the FTC, and sleep the margin targets by a year. That's not a turnaround. That's the second layer of the same financial engineering trick. So here's the thesis in one sentence. Boeing's 2005 spin-off and Boeing's 2025 reacquisition aren't opposites. They're the same play, short-term shareholder optics over long-term operational truth. Run twice, 20 years apart, by the same kind of executives. Going forward, watch three numbers. 1. Boeing's 2026 free cash flow. They guided $1 to $3 billion. The CFO has already started softening that number. If it lands below $1 billion, the math on the $8 billion 2026 debt maturity gets ugly. Second, 737 MAX delivery rate. The FAA cap is finally lifted as of March 2026, but Boeing still hasn't reliably hit even the old 38 per month limit in any single quarter. The whole financial recovery story depends on hitting 47, then 53. Third, whether Boeing announces a new clean sheet aircraft this decade. Their last one, the 787, was launched in 2003, 23 years ago. If they didn't start the next one soon, Airbus owns the next 2 decades by default. Now for the discussion question, and I genuinely want to know what you think. If the same incentive structure that broke Boeing in 2005 is still running the company in 2026, can the Spirit reacquisition actually fix anything? Or is this just postponing the next crisis to a quarter further out? Drop your answers in the comments. Quick housekeeping before you go. Everything I covered today, the $200 million Onex sale, the $3.2 billion return PE made, the $10.4 billion goodwill on an $8.4 billion acquisition, and Malave's quotes about not knowing the cost until after close. All of that is in expanded form in tomorrow's newsletter. I incline the source filings, the page numbers, and the line items, so you can verify everything yourself. If you want it, the link is in the first thing in the description, and it's also pinned in the top comment. It's free. Twice a week, one breakdown like this one. No spam, no sales calls, no upsell. Just the filings. Read so you don't have to. If today was useful, leave me a comment with the company you'd most want to break down next. I read all of them and I pick from there. See you Thursday. If you want more stories where the numbers tell a different story than the headlines, subscribe. New videos every Monday and Thursday. The footnotes are where the real business stories live. See you in the next one.